Hey, good afternoon, everybody. Uneducated economist. So, yep, the Fed decided that they're going to raise rates. Yeah, but not surprising to any of us. Taking the Fed fund rates from 2.25 to 2.5, raising it up a quarter percentage point. And they plan on doing two more rate hikes this year throughout 2019. This is what they had to say. The committee judges that some further gradual increases in the target range for the federal funds rate will be consistent with the sustained expansion of the economic activity, strong labor markets, conditions, and inflation near the committee's symmetric 2% objective over the medium term. So they're saying that as long as the economic conditions seem to be doing okay, then we're going to be doing okay as far as our rate hikes go, and that they will be doing two more of them this year. I have a funny feeling that the economic conditions in which they are saying these two rate hikes will be achieved in is going to not exist. So basically, they're saying that the strong labor market, the expansion of the economy, and inflation near the committee's symmetric. I think all those are going to be so misproportioned by the time that the next rate hikes start to come in. Maybe not the next one, but the one after that. That all the information that they're giving you right now is going to be blown out of the water. And I just saw where Ron Paul had actually tweeted something about how the Fed is data dependent and all the data is completely obscured, and so we're living in an obscured world full of data that is obscured. And right, we need to. And he says that America needs to get back to reality, and I totally agree. So yeah, the Fed is going to be raising rates. This one came out of the Bureau of International Settlements. Okay, so this is kind of like the central bank of central banks. I mean, this is like the people who deal with the settlement of international transfers between countries and stuff. And they put out a quarterly review, and it came out December 16th. And I would love to break down this whole thing for you, but it is really quite extensive and it is very long. And to be honest with you, those videos are kind of boring for a lot of people, although I know a lot of you really enjoyed them. So maybe I'll give you kind of like just a little briefing on this one. And if you guys enjoy it, maybe we can do the whole breakdown summary of it. But the whole thing is quite long as far as the review goes, and it actually has two authors to it. But I like the Claudio Borio, the first author here, and some of the things that he had to say. So like this one here, the tremors in early December had more of a flight to safety character. Sorry, let me read that again. The tremors in early December had more of a flight to safety character. Equity prices dropped again in the United States and globally, but this time bond yields declined, dipping again well below the 3% barrier. In the background, credit spreads continued to widen. So basically, what we're saying there is that in December, that we had a scare in the markets, right? And everybody kind of freaked out. But instead of dumping their bonds and everything else, what they did is they dumped their equities and bought bonds, and then that had brought the bond yields down, but that created a widening between the corporate bonds, what corporations basically borrow money for. They sell bonds, right? And that's how they kind of borrow money. So their interest rates were very high compared to the bond yields that were going on right there, because everybody had dumped their equities and bought bonds, right? And that dropped the yields down. And that's what he was saying what happened in December. And that's why it dropped, that's when bonds went from like the 3%, they actually dropped down into the high 2% range during that time. And like I said, it's a pretty good article. He actually talks a little bit about the European markets, how Italy is, basically going to drag the whole thing down, and that they almost had like this credit default swap issue. And although he referred to it as being contained, it did have some contagion effect to it. So basically, once these credit default swaps really get going and kicking off, it could create this domino effect that they won't be able to stop. And anybody who's not quite familiar with a credit default swap, basically what that is an insurance policy on an investment. So an investor gets an insurance or buys an investment, the key to it is to definitely not lose money, right? I mean, you want to make money, but definitely don't lose money. And so what they do is they buy an insurance policy that goes along with their investment. So say, for example, an investor buys a mortgage-backed security. Now, a mortgage-backed security is a group of houses, they're loans, right? So it's yours, mine, everybody else's loans all grouped together into a major security that an investor can buy. And as those loans get paid off, the investor gets reimbursed for it. And so the investor doesn't want to lose money. What he does is he buys a credit default swap that'll reimburse him for his principal on the investment should that investment fail. Okay, here's the thing. The people who sell those credit default swaps sell way more credit default swaps, way more insurance policies than there are actual investments. So, and it's kind of like an unregulated market, and that's why they're saying there could be a domino effect, that once one of these kicks off, it could start kicking off a whole bunch more, because these things are like credit default swap upon credit default swap. And so like as these investments start to fail, then these credit default swaps start kicking in, and next thing you know, you got this like crazy domino effect that starts happening from it. Sorry, I don't want to get too deep into credit default swaps. We could do a whole video just on that. But that's kind of one of the things that like killed AIG, is that when the houses started to fail and people were foreclosing on their homes, AIG had issued out way more credit default swaps than they had than the mortgage-backed securities that were out there. So like for every mortgage-backed security, they sold like, I don't know. I really don't know what the number is, but they sold more credit default swaps for it. So when the mortgage-backed security failed, they had to pay out all these credit default swaps on that failed mortgage-backed security. And, that's where like a lot of controversy and conspiracy theories come up about who got paid from AIG, because they got bailed out by the government, because massive amount of people bought the insurance policies, bought those credit default swaps, and never owned the investment, right? They just bought the insurance policy. So kind of put that, in perspective, if you can imagine somebody going and buying a ton of fire insurance, home insurance for fire coverage, and then watching the neighborhood burn down because they knew that there was an arson there or something. You know what I'm saying? That's kind of the deal that went on there. They got paid all these insurance policies watching the houses burn down, knowing that it was going to happen. Anyway, I don't want to get too deep into that one there. That's like that's kind of a far-fetched story, but there's a lot of truth that could be said in something like that. And that is just that I don't have any evidence of any of that. That is just like, it's just me kind of wild imagination and some of the things that I've heard. But there was another party. Oh, right here. This one was kind of a big deal. Despite the steady increase in credit spreads, nowhere are easy financial conditions more evident than in the leveraged loan market. Actually, let me read this whole thing to you. Despite the tightening in the period under review, the long-term prospective U.S. financial conditions are still comparatively easy. So he's saying there that even though that we've had this tightening period on the monetary policy where we're raising these interest rates, what he's going on to say here is that the financial conditions are still comparatively easy. I guess he's comparing it to the past. So he's saying that, yeah, even though we've like tightened, it's still like, we're still in an easing condition, not a tightening condition. This is so even if one considers the stock market route, right? So in fact, valuations remain rather elevated. So what he's even saying there, this is so even in one considers the stock market route. So he's saying even though the stock market has like just dropped tremendously, it's still overvalued. The valuations remained rather elevated, right? So he's saying, yeah, it dropped, but it's still like way high. And and it dropped like another 300, 400 points today after the Fed made that comment about how they're going to continue to raise rates. But this is kind of the important part that goes into it, because despite the steady increase in credit spreads, nowhere are easy financial conditions more evident than in the leveraged loan market, which continues to be overstretched. And the bulge of BBB corporate debt, the triple B corporate debt, right, just above junk status hovers like a dark cloud over investors. Should this debt be downgraded, okay, so if these triple B corporate debts get dropped down to junk status, downgraded if and when the economy weakens, right, when the economy weakens, it is bound to be substantial pressure on the market that is already quite illiquid and in the process to generate broader waves. So what he is saying there is that as these BBBs turn into junk, they're going to be a hell of a time trying to sell that stuff back into the market because nobody's going to want them. That's why he's saying they're going to become quite illiquid, like you won't be able to sell them. And in the process to generate broader waves. And he says, as that happens, it's going to get worse, right? And the reason why this is going to be a problem is because a lot of pensions, retirement funds, different things like that, when they go off and they buy these corporate debts or they buy treasuries or whatever, they have to have it above a certain grade of investment, right? And this triple B, I think, is the bottom of the line. Like, you can't go below triple B. And people out there, if you're watching this and you can kind of, and you can correct me on that if I'm wrong, that would be great. But I'm sure this is what the problem would be, is that these triple Bs, if they drop down below, if they drop a grade below that, then these pension funds and all these other people who have other people's money backing into these higher grade investments have to dump that stuff and buy higher grade investments, right, with that money. So what will end up happening is that as these things get downgraded and they start to dump them, then it starts getting worse and worse, because, you know, at one point they just, like, nobody wants these things, and they'll start selling them off for whatever price they can give for them. And that's why they're becoming so illiquid. See, like right now you could go and sell these things really easy because people are willing to give you money for them. But as they become more illiquid and you got to dump them for whatever price you get, then that's where, like, everybody's pension funds and retirements and all that start to fail. I don't know. Was there anything else in here that I really thought? Oh yeah, this is another good part of this one. It says here, let's see. Give me 1 second here, guys. In the fact since the early 1980s, economic downturns have been triggered more by financial booms gone wrong than by monetary policy tightening to quell inflation flare-ups. So back in the history, if you go back and you study monetary history long enough, a lot of people can use the argument, the moment that the Fed starts to raise interest rates, we go into a recession. And that's what he's saying has happened, right? But fact is, since the early 1980s, economic downturns have been triggered more by financial booms gone wrong than by monetary policy tightening. Okay, so that's like a big deal right there. This guy is telling you that most of these things are not like due to the Federal Reserve's action on trying to raise rates. It's due from monetary policies that have just completely boomed the economy and they can't sustain it. Okay, that's what he's trying to say here. What goes on? Monetary policy. Oh, yeah. So it goes on to say, monetary policy normalization was bound to be challenging, especially in the light of trade tensions and political uncertainty. The recent bump is likely to be just one in a series. So yeah, if you guys liked some of that stuff, and let me know, maybe we'll do a whole review on the whole quarterly BIS report, which is really good. I encourage you guys to go and check it out for yourselves. It's really good. It takes a little bit of a kind of reading over again to try and catch everything that they're saying there, but it's quite telling, and to be honest with you, it's a bit alarming as well. But not to any of us who follow the uneducated economists, right? Because, you know, this is the stuff that we talk about all the time. But yeah, so I want to thank you guys for following the channel. Thank you very much for subscribing. Thank you very much for the thumbs up. I really appreciate it. That lets me know that I'm doing well on my videos. You know, if you go and you check them out, like, I get far more thumbs up than I do thumbs down, a lot more than I would have expected. And, you know, I really appreciate that, guys. You're very supportful, and that's what keeps me going. Thanks.